Welcome everybody. I think like we are ready to go and really happy to have the opportunity of talking to you today about Amount B, for which, as you can see on the slide, we have a fantastic lineup of speakers from the OECD. So we have Achim Pross, current Deputy Director of the Center for Tax Policy and Administration, and we have four members of the transfer pricing team, Sarani da Silva, Noel Meyer, Kenjiro Tomita, and Gabriela Capristano Cardoso, who will walk us through the technicalities of Amount B in a second. And this is Manuel speaking also from the transfer pricing unit at the OECD. So just to give you a sense of like what are we covering today on this technical webinar on Amount B, Achim and myself will speak to the first point of the agenda to provide a bit of background and context on where we are coming from and how Amount B came to life to some extent. Second point will be covered by Sarani and Noel. They will be speaking about the scope and the pricing elements of Amount B. Then Kenjiro will take over and he will do a bit of a live demonstration on how the pricing automation tool works. And then Gabriela will pick up the conversation on tax certainty and implementation considerations. And then we'll allocate a bit of time at the end of the session to address your questions. So thanks in advance for all those who sent questions during the registration process. And we are looking forward to have that discussion at the end of the presentation. So with that, I think like Achim, I'm going to hand it over to you so you can walk us through the first slides.
Thank you, Manuel, and I'm going to do this without actually myself seeing the slides. So I hope the slides is coming up. It should be a slide that says, why does tax certainty matter? And Manuel is smiling, so it's probably true. So thank you, Manuel, and welcome to all of you that are joining us, that have tuned in. Thank you also for those that have been on this journey for several years now. So thank you for your comments, contributions, for late night calls and other things. I think for the engaging discussions. I remembered several panels with Manuel and others on the details. Thank you also for the input of the business advisory group. This is a journey. We've come a long way here, so very grateful for these. Also grateful for those that keep it alive in the tax press. So thank you, Mindy. So a big thank you to all of those that have been on this journey so far. What I wanted to do just before we get into the details of Amount B, the scoping, the pricing, the operations, and show you the tool is just take 1 second, and with me it's never 1 second, but it's going to be 4 minutes of just taking you back a little bit, stepping outside, on going to the context of which Amount B is a part. B is designed to bring simplicity, bring certainty, and it's part of the wider tax certainty agenda. And so at the risk of repeating something and perhaps saying the obvious, I think in this case it merits to state the obvious. Why does that matter? What is actually driving this agenda? And this we try to summarize in the slide that hopefully you can see. What are the drivers? Well, one driver, of course, is tax certainty is good for businesses. We did this in a survey together with our colleagues from the IMF in 2017. We did it again in 2019. And as you can see at that point, and I think it's still true today, 90% of businesses indicated that tax certainty is important because tax uncertainty adversely affects their business operations and costs. Now, that's a pretty obvious statement. But the other thing that is sometimes forgotten is the fact that it's not just something for business. It's actually something much wider. It's for government. It's for the economy. It affects location decisions. It affects growth. It affects jobs. It's a very important dimension as you go for businesses, for the economy as a whole. And then finally, of course, also when we talk to our tax commissioners in the Foreign and Tax Administration, it's important because tax certainty can also reduce resources significantly, where otherwise it can eat significantly into resources, whether that's on audit, whether that's on MAP, whether that's on domestic remedies. So it's a win for all of us. And we still note that too many of these routine transactions that I think we've been trying to keep out or get through transfer pricing quickly and in the most efficient way still end up in the MAP pipeline. And I think that's a big context and the underlying driver too much of the work that we're doing here, and that is powering this agenda ahead. It did this in the past, and it will continue to do so in the future. If we now go to the next slide, because I mentioned that Amount B, and this is important to see the context, is a part of, an important part of, but just a part of that wider tax certainty agenda that goes, and you've seen this on tax certainty days, that cuts across simplification, That's ideal. That's the gold standard. The rule is simple, but then also dispute prevention and dispute resolution. So if we then look at amount B, and I hope you see this now, amount B is a part of the simplification journey. If the taxpayer can apply the rule is sufficiently simple. If the tax administration agrees, and importantly also then the tax administration of the counterparty jurisdiction agrees, that is clearly the A plan. You don't need to spend resources on compliance work. Business can do its business, which is what it's supposed to do. Now, what this also shows you, and this may be relevant, just that amount B didn't fall out of the sky. There's a context here. There's been work, and Manuel will be talking about this, whether it's model competent authority agreements that were MAP, not the assessment stage, and that didn't quite have a standardized pricing framework in it, whether it's then the safe harbor that we did later on with a very simple pricing matrix built in, a pricing approach, whether then the standardized benchmarking, which we did later, which came out of the Santiago communique, thank you to our Chilean colleagues, and then in part also standardized benchmarking was one road on which we also traveled to amount B, but the work also continues. So that's a big part, I think, of simplification. And here I'm only talking about the simplification inside transfer pricing. There's many others on the wider tax certainty agenda that we're leaving off today because it's focused on B. And that's certainly a journey that continues. And then there's the big part here, I think, on dispute prevention. When there are situations where you realize that the rule application may result in disputes and disagreements, or conversation early engagement in a trusted environment. The cooperative compliance notion, which we have then taken and incorporated in ICAP. Every time I do these things, I do need to talk about ICAP. The International Compliance Assurance Program, which we are continuously improving in light of the feedback that we get from businesses, from advisors, from stakeholders through the ICAP steering group. And for those that follow it, only last week we released streamlined documentation. We also got rid of the application deadline. So now ICAP you can do at less burdensome, and you can come in anytime. And there's also improvements that we're making in APA, whether that's a bilateral dimension or a multilateral dimension, recognizing the integrated nature of supply chains. And there's also things that are happening at domestic level where people are exploring alternatives, innovating, such as, for instance, the recent Indian initiative on assessments in 3-year blocks. And there's other things also at the domestic level. And then there's the joint and coordinated audits in situation where it does get to an audit, then can we coordinate the audit work rather than do it separate and how it is. And so we go through the whole tax certainty value chain. It then goes to MAP. I'm not going to talk about it because otherwise I'm way out of my 4 minutes. You know Tax Certainty Day, you know the work that we do, you know the peer review, the statistics, which covers MAP and now also APA. And then, of course, the work on arbitration. So let me then just finish in my remaining 30 seconds. You know, there is a lot to look forward to in the remainder of this webinar focused on amount B. So stay tuned for this webinar, but also stay tuned for that wider tax certainty journey where we integrate these different elements that all drive us forward on that idea of improving simplicity, of making it easier, of allowing businesses to do what they want to do, which is the business. And that is things such as the Tax Certainty Roundtable, such as Tax Certainty Day, and importantly, the plenary of commissioners that have a core and keen interest on this tax certainty agenda, and where we also look at holistic initiatives, best practices, ideas, incentive structure, culture. What can we do to improve here, product specific, but also holistically, including looking at the data, working back from map, and taking that and help us drive solutions to the problems that we still see. So stay tuned. And with this, back to B and back to Manuel.
Yeah, thanks a lot, Achim. And just to provide a bit of context and to frame the conversation, picking up on the point that Achim was making about amount B not falling from the sky. So for all the TP nerds out there, we've put here like the milestones during the last probably 10, 11 years. of like the different steps towards simplification in the space of transfer pricing. As Achim said, like we probably started this journey in 2013 when we included in the OECD transfer pricing guidelines as an annex to Chapter 4 three memoranda of understanding that were intended to operate as model for competent authority agreements on three activities, low risk ones, in particular distribution, manufacturing, and R&D. Then the simplification journey took a step further with the inclusion after BEPS 2015 of the low value adding services in Chapter 7, for which we are seeing a very positive uptake since, and that's reflected in the OECD transfer pricing country profiles in the OECD website that, by the way, we will be updating during 25 to make sure that info from countries is up to date. And then that moved into what Achim was alluding to, the work that the FTA, the Foreign and Tax Administrations, mandated to standardize and simplified benchmarking practices by tax administration, and that was reflected in the Santiago communique of 2019. And I think all that allowed us to create that momentum for the inclusive framework to think about Amount B. And that's reflected, obviously, in the inclusive framework mandate of October 21st. And I'm not going to read the mandate. I think all of us are pretty familiar with it, and probably we all know it by heart. But there are probably two comments that I would like to put around the mandate. I think the first one is that it's clear from the mandate that the design of Amount B had to carefully consider striking the right balance between simplification and reliability. So in other words, we had to do things different to some extent to simplify the transfer pricing practices for baseline marketing and distribution activities. But at the same time, we had to make sure that for the inclusive framework to remain faithful to the arm's length principle in the outcomes, I think the outcome should needed to be reliable enough to fit within the transfer pricing guidelines. The second point that derives from the mandate is that when you look at the design of Amount B, and the team will be walking us through the different elements of Amount B, there are a number of design elements of B that need to be considered only in the space of Amount B. So in other words, decisions in terms of design of Amount B that were taken by the inclusive framework in coming up with the Amount B guidance should not be carried over to other elements of the transfer pricing guidelines. I think that's recognized in several points of the Amount B guidance. And then just before handing over to the team to tackle the different technical elements, we thought it would be helpful to pause for a second and give you a timeline and an overview of like what we've been producing at the inclusive framework level on Amount B during the last 12 months. So everyone has this holistic picture in mind and we are able to put the pieces together. So if we look back 12 months ago exactly, in February 24, the inclusive framework published the Amount B report that included the Amount B guidance that was included then in the OECD transfer pricing guidelines as an annex to Chapter 4. Back then, it was recognized in the report that there were a couple of missing elements for Amount B to become or to be fully implementable by jurisdictions. And those elements were tackled in the report of the inclusive framework in June 24, where that publication covered two critical elements. One of them, the definitions of qualifying jurisdictions for the purposes of sections 5.2 and 5.3 of the Amount B report, and Noel will be speaking to those, and the definition of covered jurisdictions that is something critical in terms of like the implementation of the inclusive framework political commitment, which is also like a very important element of the design of Amount B, and Gabriela will be picking this point towards the end of the presentation. Then farther down the road, September 24, the inclusive framework published the Model Competent Authority Agreement in order to facilitate the implementation of the inclusive framework political commitment. And finally, towards the end of last year, in December, we published further tools to help with the implementation of Amount B. One of them in particular, the pricing automation tool that we will be discussing a bit later on today in the session. All those steps led us to January 25 this year, where as of when jurisdictions are able to start implementing Amount B, and just addressing some of the questions we've already received in terms of like, how can we get information about which countries are going to be implementing Amount B in 25? I think probably the answer is stay tuned. During the next few days, we will be updating that information in the OECD website. And then finally, that leads us to today, February 25, where we are having this technical webinar with the idea of, again, putting the pieces together, walk you through the different technical elements and get a bit of like your feedback and your questions so we can try to address those points. And a bit of an announcement to conclude is that in the next 2 weeks, we will be publishing in the OECD website a consolidated report in Amount B that is not going to change anything on substance relative to what the Inclusive Framework has published during the last year, but will just rather put all these pieces I've been talking about in just one single document for ease of reference. So hopefully that helps also like for jurisdictions and stakeholders to get a better grasp of the components of Amount B. And with that, I'm going to hand it over to Sarani, who will walk us through the scoping elements of B.
Thanks, Manuel, and welcome everyone. I'll be going over a bit of an overview of the scoping framework for Amount B. Apologies, if we could go to the next slide, please. Thank you. So just as some context, as Manuel outlined, Amount B is a simplification measure. And so in terms of the scoping framework, the way that it was developed was really to identify the types of marketing and distribution activities that could be reliably and appropriately priced using something like a simplification measure such as Amount B. What that means is that as we go through the presentation, you'll see there are some components of this analysis that are quite different to a traditional transfer pricing analysis, and there are some components which do still draw on existing principles and approaches. In terms of the scope, there are two main components. So the first relates to the identification of what a qualifying transaction is, and the second relates to specific scoping criteria that are then applied to the qualifying transaction to test whether it should be in scope or not. So in terms of the qualifying transactions itself, they relate to wholesale distribution of tangible goods to unrelated parties by buy-sell marketers and distributors, commissionaires, as well as sales agents. For the purposes of Amount B, the definition of wholesale distribution also includes a component of retail sales activity. So to the extent that an entity does wholesale distribution and up to 20% of their net revenues also come from retail sales, then both those activities can be priced under Amount B and would be considered part of the qualifying transaction. We then move on to the actual scoping criteria themselves. So the first scoping criteria is that a qualifying transaction needs to be able to be reliably priced using a one-sided method. And what that means is that in assessing whether a qualifying transaction is in scope, consideration needs to be given to the types of characteristics that would indicate that perhaps a two-sided method should be used instead, such as a profit split. Those types of characteristics commonly include contributions to and ownership of unique and valuable intangibles, as well as the assumption of economically significant risks. So where those types of characteristics are present, that type of transaction would not be in scope of Amount B. The second scoping criteria is purely quantitative, and it's based on an operating expenses to sales ratio. So the range of that ratio is 3%. So an entity needs to have a minimum of 3% operating expenses to sales and a maximum of 20 to 30% of operating expenses to sales to qualify for Amount B. The upper parameter does provide a range, which means that adopting jurisdictions can essentially choose what the upper bound of that quantitative criteria is, and they can determine kind of the proportion of their distribution activities that they would want to fall within scope of Amount B. So to the extent that those criteria are met, a transaction is within scope. However, there are also some specific exclusions in the scoping criteria. So the first is in relation to the products that are distributed. As I mentioned previously, Amount B relates to the distribution of tangible goods, and there are exclusions in relation to non-tangibles and services. There is also a product-based exclusion in relation to commodities. The second exclusion relates to multifunction entities, so entities where there are both distribution activities and non-distribution activities occurring. So to the extent that an entity performs distribution, but also, for example, manufacturing or research and development, such entities would be excluded unless the non-distribution activities can be reliably segmented. To the extent they can be reliably segmented, then the distribution activities can still be priced using Amount B. If we can just go to the slide with the first diagram, thank you. So this slide essentially provides kind of a basic fact pattern that we would typically see Amount B applying to. So as you can see, there are a couple of transactions here. The first relates to a manufacturer producing finished goods on behalf of a principal. The principal then sells those goods to the wholesale distributor, which then on-sells to unrelated parties. So in this scenario, the transaction that Amount B would be seeking to price is transaction number 2, which is the sale of goods between a related party principal and wholesale distributor. If we can jump to the next slide. In this scenario, again, a somewhat similar fact pattern, but this instead shows how it would look in relation to commissionaire arrangements. So as per the previous example, you have a contract manufacturer producing product for the principal, but in this scenario, it is the principal itself selling goods to the unrelated parties, and the commissionaire entity is performing local sales activity on behalf of the principal, but never actually takes title to the goods. Under the Amount B guidance, transaction 2 in this scenario between the commissionaire and principal can also be reliably priced using the Amount B approach. If we can please go to the final slide for scoping. So we've gone through the scope, and then we get to selection of methodology. So to the extent an entity falls within scope of Amount B, after going through and passing all of the criteria that we just reviewed, there is an assumption within the guidance that the T&MM is the most appropriate and reliable transfer pricing method to be used to that kind of entity. There is one exception, which is that to the extent an internal cup method is available, then the internal cup is considered a more reliable approach than Amount B, given obviously the existing principles around the reliability around internal cups. So in practice, we think that would be a relatively rare occurrence, but the exception is there to the extent that a more reliable method is available. With that, I will now hand over to Noel to go through the pricing.
Thank you, Sarani. So just move on to the first slide here. So as Sarani indicated, once you determine that you have a qualifying transaction and you meet the relevant scoping criteria, effectively then you are applying the Amount B pricing framework, which works as an off-the-shelf pricing solution. There are 3 critical components in the Amount B pricing framework. The first is the pricing matrix, which allows taxpayers and tax administrations to effectively determine arm's length ranges for in-scope distributors, but based on specific company-level factors, which I'll come on to. The second critical aspect is the operating expense cross-check, which is an adjustment feature that is intended to mitigate the risk of over and under compensation using a secondary profit level indicator. And the third and final kind of critical feature of the pricing framework is the data availability mechanism, which is also an adjustment feature. And that's intended to provide a country risk premium, in effect, to distributors that are operating in designated higher risk markets. For simplification purposes, we do use return on sales as the applicable profit level indicator for all in-scope entities. So when we get to the matrix, you'll see that all of the rates referenced are effectively return on sales. The final point here, just to recognize that obviously this pricing work has been centralized, which is one of the key benefits of Amount B, but crucially also the maintenance and ongoing updates to Amount B will also be centralized. Next slide, please. Just to briefly work through some of the work of the OECD through Working Party 6 and the FTA MAP Forum, we effectively conducted a centralized benchmarking search, as I mentioned, using common search criteria, and that led to the development of this global data set of about 6,000 companies that are involved in baseline distribution activities that, broadly speaking, align with the scoping criteria that Sarani outlined. The benchmarking and econometric work, which we've been undertaking for the last number of years, effectively had two kind of core objectives. The first, to help us identify the existence of company and country level factors that may correlate with distributor profitability and be useful in informing Amount B pricing design, and then ultimately being able to produce arm's length ranges that could be readily applied to in-scope distributors. I think it's worth emphasizing that on the back of that econometric analysis, we did observe a wide range of variables where we observed a statistically significant relationship to distributor profitability. However, to Manuel's point, every kind of design feature we had to seek to strike an appropriate balance between simplification and reliability. So ultimately, 3 specific factors were selected as being suitable to incorporate into pricing matrix design. Those 3 factors are industry grouping, representing effectively the products distributed by the tested party. Secondly, we have operating asset to sales intensity, or OAS, of the distributor. And then finally, we have the operating expense intensity of that tested party. Moving on to the next slide. So here is all of that, I guess, econometric analysis and the global data set data translated into a 15-cell pricing matrix. And what you can see is we have 3 industry groupings, 1, 2, and 3 across the horizontal dimension, and then a combination of what we refer to as OAS and OES levels across the vertical dimension. So effectively, it allows you to pinpoint a specific approximation or arm's length outcome for your tested party, meeting those specific profit-driving factors. Now, recognizing the challenge of hitting a single number, the guidance does provide for some flexibility such that taxpayers and tax administrations can work with the return referenced in the respective cell, plus or minus 0.5% around that point. So just as an example, at the low end of the pricing matrix, if you are an in-scope distributor operating in industry grouping 1 with the lowest levels of OAS and OES, and Amount B return can range from 1% to 2% return on sales. And then similarly, at the high end of the range, if you're in industry grouping 3 with the highest levels of OAS, the Amount B return can range from 5% to 6% return on sales. Next slide, please. So I think most people will be familiar with the principle relating to making comparability adjustments as it relates to, let's say, transactional net margin methods, such that any such adjustments should be made or only made if they're expected to improve the reliability of the results. And so with that principle in mind, Working Party 6 did ultimately explore the case for making various different types of adjustments that seek to improve the reliability of Amount B. Now, on the other hand, again, we're trying to strike this appropriate balance. If we make too many adjustments or adopt too many adjustment features, you make Amount B too complex. So ultimately, we settle on adopting 2 specific features which are implemented with a view to safeguarding ultimately the ability of Amount B to approximate arm's length outcomes. Next slide. So before we get to maybe a demonstration of the pricing automation tool, which will help bring some of these key features to life, just to quickly articulate what those 2 adjustment features are. So first of all, we have this operating expense cross-check. So this is intended to recognize that we do use return on sales in the pricing matrix, and that may not always be the best profit level indicator for every single distributor. And therefore, this operating expense cross-check allows us to use a secondary PLI, which is return on the operating expense, as effectively a corroborative check to safeguard against over and under remuneration. So in very simple terms, you would determine the amount B returned for a given tested party. You would translate that into a return on OPEX, and then you compare that to a predefined cap and collar range. To the extent the return on OPEX for your tested party falls within the predefined cap and collar range, no further adjustment is necessary under this step. However, if you fall outside of the range, the amount B return can be adjusted up or down to ensure that cap and collar range test is satisfied. Just to highlight then briefly, we do have a standardized or fixed floor rate or collar. So that presents or represents a minimum return on operating expenses of 10%, which would need to be satisfied under this test. However, from a cap rate perspective at the upper end of the test, it's a bit more complicated. We actually have a cap rates that can vary from anywhere between 40% and 80%, depending on the characteristics of the entity. And again, further details are included in the amount B guidance. And finally, from a pricing perspective, the second adjustment feature, which I've already kind of mentioned, is the data availability mechanism, or DAM. This DAM provides an upward adjustment to the return derived from amount B in certain cases, and in effect is intended to compensate a distributor if it's exposed to higher country risk relative to the global data set. So it applies only to qualifying jurisdictions, and we have various qualifying criteria to get onto that list, but it includes ensuring that we have insufficient comparable data in our data set, but also evidence using sovereign credit ratings that jurisdiction constitutes reasonably a higher risk jurisdiction. So we're using sovereign credit ratings not because it's perfect, but because it's an effective proxy for identifying and quantifying these risk premiums. And again, further guidance is available on how this mechanism operates. We think it's especially relevant to developing countries where we do routinely observe evidence of higher operating risks, not least as evidenced through lower than average sovereign credit ratings. So effectively, this data availability mechanism produces a risk premium, which then gets added to the amount B return determined from the previous steps. So maybe to bring this to life a little bit, happy to hand over to Kenjiro now.
Thanks, Noel, for handing over to me. So let me guide you through how the pricing tool works. So let me, could we go to the next page? Okay, so for this purpose, I'm going to use a couple of slides to show you the overview of the pricing tool, and then I'm going to move on to the demonstration of the tool using the tool itself. And it has been developed to automatically compute the amount B return for in-scope transactions with minimal data inputs. And that is intended to optimize the administrative and simplification benefits for both tax administrations and taxpayers. And as in the slide, it completes all calculations for the quantitative scoping criterion and the pricing mechanisms. And there is no predetermined way of how you use it, but it could be used as a first step to see if a wholesale distribution meets the quantitative scoping criterion before undertaking the qualitative checks. That should be done through the accurate delineation of actual transactions. That could be a resource intensive. And as you may be aware, the pricing tool was already published on the OECD website in December. So all of you have access to it on the website. Could you go to the next page? And this shows the overview of the pricing tool. And as in the slide, it has 4 pages. The first page is the guidance page on how to use this tool. So I will recommend you reading this page when you use the tool for the first time. And the second page is inputs for scoping. That completes the calculations for quantitative scoping criterion, and you can check the result on the same page. And the third page is the inputs for the pricing purposes. And with the inputs to this tab, the tool completes all calculations for pricing purposes, including the application of the pricing metrics and the 2 adjustment features that Noel just explained. And the last page contains a copy of all calculations done by the tool. So that is just for information, and no inputs is required for this page, but that would be a useful information for you to understand how amount B calculation will be done. Could you go to the next page? So here is a list of information that you should fill in to calculate the return with the pricing tool. I'm not sure how you feel it, but only with these information and inputs, you can get the result on the application of amount B. And with that brief introduction, let me move on to the demonstration of the tool. So basically, what you should do with this tool is to fill in the green cells on the left side of the tab. Then you can automatically get the result on the right side. So for the purposes of this demonstration, I already filled in the same information as illustrated example 1 of the amount B guidance. So as you see, this is the input tab for scoping. And as Sarani explained to you, the operating expense intensity, OES, should be between 3% multiplied by jurisdiction. You are using this tool and filling that information to this cell. And as you will see, the information from 3 previous years is required, year X minus 3, 2, and 1, because the operating expense intensity should be calculated using the 3-year weighted average. Then when the quantitative scoping criterion is met, this message in yellow is displayed on the right side of the tab. But for example, when your operating expense is 1,000 and the scoping criterion isn't met, the message in red is displayed on the right side. Then if that happens, you cannot use amount B to a given case. And one caveat to this tab is, as in the note here, the tool cannot automatically test the qualitative aspects of the scoping criteria. So due consideration should be given to those qualitative aspects before you reach the conclusion on the applicability of amount B to a given case. Then let me move on to the tab for the pricing. Again, all you need to do is to fill in the green cells on the left side, and then you get the results on the right side. So let me show you how the output summary on this tab looks like. And output summary is divided into 3. One is for pricing metrics, and second is for operating expense cross-check, and third one is for data availability mechanism. And this follows the order of application of these mechanisms stipulated in the amount B guidance. And at the very bottom, you can see the final return on amount B. Then let me move on to the input field, where you should fill in 3 types of information. The first is the information about the jurisdictions, and that is necessary for the purposes of application of the operating expense cross-check and the data availability mechanism. And second one is the financial information. That is the basis for calculating the operating expense, the operating asset intensity, OAS, and OES. That is a core information to apply the pricing metrics. And one caveat to these tables on the financial information is segmentation. So for example, when you are carrying out non-distribution activities, like manufacturing activities, for example, you should segment out such non-distribution activities and fill in information relevant only to the qualifying jurisdictions, to qualifying transactions. And lastly, number 3, you should also fill in information on industry grouping. That is another core element to apply the pricing metrics. Just for your information, the definition of industry grouping is available in the definition section of the amount B guidance. And you also have the small table here to identify the industry grouping of the products being distributed. So for example, if you're distributing grocery, that's industry grouping 1. But for example, when you're distributing health and well-being products, that's industry grouping 2. And that information can be used for you to fill in this cell because that's relevant for the application of the pricing metrics. Then let me change some inputs to show you how that affects the results. So as you see in the summary, with the current information, the factor intensity classification is C, and the industry grouping is 1, and the return on sales under amount B is 2.5, and no adjustments are made under 5.2 and 5.3. Then when, for example, when I increase fixed assets, that increases the OAS and change the factor intensity classification to B, and the return is going up to 3% accordingly. And one thing you may not be familiar with in this output summary is the accounts payable guardrail, which you can find here. So I don't go into too much detail, but that guardrail is intended to mitigate the risk of distorted credit terms. So for example, if you have excessively high creditors at year end, that decreases the OAS. That is a core factor to determine the rate of return under amount B. And then you can get lower return if there is no guardrail like that. But with that guardrail, there's such a kind of an intentional lowering of the amount of return will be prevented. So for example, if you have very high creditors, but still the amount of return is 2.5% because of the application of the accounts payable guardrail. As you may be aware, this was changed to yes from no. Then on industry grouping, as Noel explained to you, you get higher return when you are distributing the products falling into industry grouping 2 and 3. So for example, if you are distributing the products in industry grouping 2, for example, the rate of return was changed to 3% from 2.5%, because if you get higher return when you are distributing the products in industry grouping 2. And there could be a situation where you are distributing the products falling into more than one industry grouping. Then the pricing mechanism requires you to calculate the weighted average return if you earn more than 20% of sales from the sales of second and third industry groupings. Then if that's the case, you should choose more than one industry groupings here. Then as you may be noticed, the gray outed cells were changed to green. That means that you have to fill in this table. And with this example, as you see here, the 40% of sales comes from second and third industry groupings. That means that the weighted average calculation is required that you can check here. So with that weighted average calculation, the rate of return is going up to 3.08% because of that. And practically important point would be that the segmentation of OAS is not required even when you are distributing products falling into more than one industry grouping. Just make a distinction. As I said, if you're carrying out non-distribution activities, they should be segmented out. But if you are only engaging in in-scope transactions, distributing multiple products, falling into multiple industry groupings, then segmentation is not required. That is made clear in the guidance of the amount B. Then let me move on to the demonstration of how operating expense cross-check works. As Noel said, that assesses the return derived from the matrix by reference to the operating expense level. And also, as Noel said, there is the predefined range of operating expense cap and collar under the mechanism. And adjustment could be made upward or downward depending on the operating expense level that a given company has. So as you will see with the current information, OPEX cross-check is not triggered, no adjustment required under this section. But let's suppose that you have a very low level of OPEX of 5 in year X, then the OPEX level that is called equivalent return on OPEX in amount B jargon is above the cap rates of 60%. Then if that happens, the downward adjustment should be made. And with this example, the downward adjustment of 1% is made to the return derived from the pricing metrics. So after subtracting 1%, 1.5% of the final amount be return with this example. And similarly, there could be an upward adjustment if you spend much higher operating expenses in year X. So you can use this tool to see how this mechanism applies to a given case. And an additional feature of this mechanism is an alternative cap rates that Noel briefly mentioned in his presentations. That's mainly for developing jurisdictions. So I don't go into too much details, but the cap rates will change depending upon the factor intensity classification of a given case and whether a jurisdiction where a distributor is located is a qualified jurisdiction or not. And if a jurisdiction is a qualifying jurisdiction, higher cap rates that are called the alternative cap rates are used. So when I change the country to X, from country X to Y, that is a qualifying jurisdiction for this purpose, the alternative cap rates would be applied. So with the alternative cap rates, the OPEX cap rates applicable here is going up to 70%. And that means that the return on sales is capped at higher rates. Then the final return is 1.75% rather than 1.5 with the country X. That is a non-qualifying jurisdictions. And just in case, the published version of the tool has a list of jurisdictions, so you can check the status of your jurisdictions with that published version. And the last piece of the pricing mechanism is the data availability mechanism. And first, as Noel explained to you, the data availability mechanism is relevant only for qualifying jurisdictions. So with the example of country X, that is non-qualifying jurisdictions, the data availability mechanism is not applicable. So that tool says that no adjustment under 5.3. But if you are in a qualifying jurisdiction, which is country Y, with this illustration, then the adjustment is required under section 5.3. And we use the operating asset intensity and sovereign credit rating of a given jurisdiction as a factor to determine the rate of adjustment under this mechanism. And with the credit rating of B and this factor intensity, operating asset intensity, the adjustment percentage with this example is 1.11%, and 3.61 is the final amount B return with this example. Again, the list of jurisdiction is available on the published version of the tool, so please check to see if your jurisdictions are the qualifying jurisdiction for this purpose. And lastly, just for your information, as I said in the beginning, the copy of all calculation is available on this tab. So you can trace all calculations that could be helpful for you to familiarize yourselves with the calculation of this mechanism. So that's it for me on the demonstration of the tool. So let me hand over to my colleague, Gabriela, to guide you through the implementation aspect of Amount B.
Thank you, Ken. As we put up yes, I can see the slides now. So I'm going to talk a little bit about tax certainty and implementation on Amount B. As we already mentioned, Amount B report was published in 19 February 2024. And since the date of publication, it is considered incorporated as an annex to Chapter 4 of the OECD Transfer Pricing Guidelines. Now, Amount B is an optional approach, meaning that jurisdictions can choose to apply Amount B or not. It is also not restricted to the inclusive framework because it is incorporated in the OECD transfer pricing guidelines, and the OECD transfer pricing guidelines is widely used even beyond the IF membership. So even countries, even jurisdictions that are not members of the IF, they can indeed choose to apply Amount B. So jurisdictions that choose to apply Amount B, they can do so from January 2025, and they have two options of application. They can apply Amount B either as a rule or as a safe harbor. And we are going to touch on the differences of those options of implementation in the next slides. Now, regardless of how a jurisdiction chooses to apply Amount B, the application of Amount B to tested party distributors on the Amount B jurisdictions is not binding on the counterparty jurisdiction, with the exception of when a jurisdiction applies Amount B and that jurisdiction is a covered jurisdiction according to the political commitment that was agreed by the inclusive framework. And this is with the aim to enhance tax certainty. And as Achim was saying in the beginning of this webinar, Amount B, it fits within the simplification and the tax certainty agenda. So the political commitment, it's very important to enhance tax certainty. And within this realm of tax certainty, it's also important to note that Amount B can also be used to resolve MAP disputes, but only where both competent authorities agree to do so. If we have a bilateral MAP or a multilateral MAP and one of the competent authorities do not agree to apply Amount B to that MAP, then the parties involved in the MAP and any resulting arbitration will need to substantiate their arguments based on the reminder of the OECD transfer pricing guidelines. So, as I mentioned, there is a political commitment within the framework of Amount B, and this political commitment by the inclusive framework is applicable to covered jurisdictions with the aim to enhance the tax certainty for both business and tax administrations of covered jurisdictions. So the main effect of this political commitment is that contrary to the general rule of Amount B not being binding on the counterparty jurisdiction, under the political commitment, the application of Amount B by a covered jurisdiction to their tested party distributors located in their jurisdictions become binding on the counterparty jurisdiction under certain conditions. So the application of the political commitment depends on the domestic and legal framework of the counterparty jurisdiction, and it's also restricted to situations where there is a bilateral tax treaty between the counterparty jurisdiction and the covered jurisdiction. Also, the counterparty jurisdictions retain the right to verify the scoping criteria. So they retain the right to verify whether that qualifying transaction is indeed an Amount B transaction and if the pricing methodology was applied correctly. The current list of covered jurisdictions is composed of 66 jurisdictions that were selected based on a criteria that was agreed by the inclusive framework. And you can see in detail this criteria in the publication of the list as well. We also published this definition. And also for tax certainty purposes, this list is locked for the next 5 years. And then after that, it will be reviewed every 5 years to allow the inclusive framework to verify whether the list of covered jurisdiction still meets the criteria, the definition criteria, or if there are other jurisdictions as well that are currently not part of the list, but then could become part of the list after that review in 5 years. the manner in which the jurisdiction decides to apply, give effect to this political commitment depends on the domestic framework of each jurisdiction. However, for those jurisdictions that will need a competent authority agreement in place with the covered jurisdiction to give effect to this political commitment, the inclusive framework has agreed on a model competent authority agreement to facilitate this implementation. And that's also available on the OECD website. Now, finally, as I mentioned, there are two options for jurisdictions to apply Amount B. They can do so as a rule or as a safe harbor. And the main difference here is who can apply Amount B. So this table helps visualize this application. As you can see here, when you have a jurisdiction that applies Amount B as a rule, then both the taxpayers and tax administrations should apply Amount B to transactions that meet the scoping criteria of Amount B. The tax administration of the tested party jurisdiction can verify the scoping criteria regardless whether the taxpayer has applied Amount B or not. And if the tax administration arrives at the conclusion that that transaction should be Amount B transaction, then it can assert the application of Amount B to that taxpayer, even if the taxpayer has not initially applied Amount B. So that's different from when jurisdictions apply Amount B as a safe harbor. As a safe harbor, you have election of the taxpayer. So the taxpayer can choose to apply Amount B or not. If the taxpayer chooses to apply Amount B, then the tax administration of the tested party can verify the scoping criteria to make sure that the taxpayer has indeed applied Amount B to a transaction that is within scope. And if the tax administration comes upon a transaction that believes it should be Amount B transaction, but the taxpayer has not elected to apply Amount B, then under the safe harbor, the tax administration cannot assert the Amount B on the taxpayer. Under both scenarios, either as a rule or as a safe harbor, the application of Amount B is non-binding on the counterparty jurisdiction, unless in the case of a covered jurisdiction in the political commitment, as we just saw. So with that, I will hand it over to Manuel. Thank you.
Thanks, Gabby, and thanks everyone for walking us through the insights of Amount B. I think we might be a bit late, but we would like to have a bit of a live session here, and we will be picking some of the questions we've received. I think, to be honest, we've got probably over 70 if we put together the ones we've received live today, plus the ones we received during the registration. So we are going to try to go through some of them. For those that are not lucky enough to get an answer, don't despair. We'll try to follow up after by email or bilaterally. Thanks a lot anyways for the question. So let me see if we can select a few here. Okay, I think Gabby, probably the first one it's for you. Like the question being, can we still apply the TNMM or another transfer pricing method if Amount B results in a lower margin?
Thank you, Manuel. This is an interesting question. So it depends on whether the jurisdiction has applied Amount B either as a rule or as a safe harbor. So the application of Amount B does not depend on the remuneration that you will get from the transaction, but rather if the jurisdiction has applied as a rule or as a safe harbor. Because if the jurisdiction applied as a rule, doesn't matter what remuneration it will get under the TNMM or any other transfer pricing method. But if the transaction is within the scope of Amount B, then the taxpayer needs to apply Amount B. However, if the jurisdiction applied as a safe harbor, then it's at the election of the taxpayer, and the taxpayer can verify under its facts and circumstances whether it should make that election or not. However, to allow for tax certainty and to avoid taxpayers getting in and out of scope of amount B for the same transaction, the guidance says that it's recommended that once the taxpayer makes the election to apply amount B, it should keep that election for at least 3 years, unless there are changes in the facts and circumstances. And maybe another point to make is that the guidance also says that the remuneration of amount B should not be seen as a floor or as a ceiling for the type of transactions covered by amount B. So that's another pointer, that remuneration should not be the guide to apply amount B or not.
All right. No, thanks, Gabby, for the answer. I think there is another good one. Maybe Sarani, this could be for you. The question is about certifications of regulatory compliance that are attributed to a particular distributor. And the question is whether those could constitute unique and valuable contributions, and then the distributor should be out of the scope of amount B.
Thanks, Manuel. Unfortunately for this one, I'm going to give a typical transfer pricing response, which is it depends. So I suppose if we go through the scoping criteria, the first test is around, as I mentioned, whether the qualifying transaction can be reliably priced using a one-sided method. So to the extent that the activities that are described in relation to the regulatory compliance certifications are considered unique and valuable under the existing principles in Chapter 2 of the TPG, and therefore a two-sided method should instead be used. It could be potentially that such a transaction would be out of scope, but it would very much depend on the facts and circumstances and the functions, assets, and risks of the distribution entity in performing those activities. The second consideration then is also whether the activities relating to obtaining those certifications, whether those can be reliably segmented from the distribution activities. Again, under that exclusion that I went through earlier, to the extent there can be segmentation, then it could be the possibility that the distribution activities themselves would still remain within scope of amount B. Thank you.
All right, thanks, Sarani. Noel, I think like you've been speaking a bit of like the data availability mechanism, and there are a few questions on the chat around that, whether you can unpack that a bit, and also to talk about the data source for the calculations of the dam.
Yeah, sure, Manuel. So yeah, I think first of all, it's worth emphasizing that it's only applicable, as we said, in qualifying jurisdictions. So they are jurisdictions that are pre-designated as constituting higher risk jurisdictions for amount B purposes. Again, we use sovereign credit ratings and data availability as two of the qualifying criteria there. But we do have a list published on the amount B page of about 130 countries. So to the extent you have a distributor operating in one of those 130 countries, the dam is potentially applicable if it's an amount B jurisdiction. In terms of the mechanics and the data source for the adjustment, we rely on publicly available government bond spread data for each credit rating grade. That information generally is collated and published by kind of a prominent professor at NYU Stern School of Business. It's Ashwath Damodaran. He's kind of pretty famous in corporate finance purposes, and he has methodologies and data which is often used for estimating the incremental risk of investing in the capital markets of different jurisdictions. For amount B purposes, we kind of take that approach and we tinker with it and tailor it and effectively use it as a proxy for estimating the incremental risk faced by a distributor that operates in one of these higher risk qualifying jurisdictions relative to the risk that we observe or is expected to be occurring amongst the companies and jurisdictions that are represented in the data set. So there's already a degree of country risk represented in the pricing matrix, and what we're trying to do here is use a methodology. We're not creating a new methodology. It's a methodology that's already in existence in valuation circles, and use that to ultimately compute a premium that gets added to the amount B return. So again, something very relevant for developing countries. And if people do want to play around with that formula a little bit, again, I would point them to either the examples in the amount B guidance or indeed the tool that Kenjiro talked us through in terms of working through the mechanics of that data availability mechanism.
Yeah, thanks a lot, Noel. That was a good one. If you bear with us for a few more minutes, probably there are like two good questions to wrap up the session. I think like we got a few, Ken, on the pricing automation tool, and I think there is a general theme asking whether the pricing automation tool is applicable also when you have entities undertaking several businesses, and only one of those is actually a marketing and distribution that falls in a scope of Amount B.
Okay, thanks, Manuel. The simple answer is yes. You can use a pricing automation tool for these businesses, but only if you can segment out non-distribution activities, such as manufacturing activities, for example. If you can segment out these activities from the financial information, then you can use the pricing automation tool to calculate the in-scope transactions.
All right. Thanks a lot, Ken. I think the last one, Achim, is this one is for you. This is what are the benefits that Amount B can bring to low capacity jurisdictions?
Thanks, Manuel, and thanks for letting me get the last question. I think we can go on for an hour, but people need to move. It's an exciting topic. Certainly, we can spend days, and we have days and weeks and months and years now. I think there's a couple of things that are interesting here. I mean, one is we have seen in the discussions in the inclusive framework and the input from business, a very interesting, like almost a laser focus of smaller developing countries and businesses pushing in exactly the same direction, in the direction of simplicity, of being able to operationalize with the minimum level of resources, of automation. So there's a lot of these things that come together. And so there's a lot of voices that came from some of those smaller members, and a large number of them on different continents that then found themselves in the solution. And it's not surprising when you think about some of their key concerns, and then you look about the Amount B approach and you see how these solutions address these concerns. And what are these concerns? There's one, the lack of local data, the lack of comps, of local comps, the missing access to databases, and the expensive licenses they can't afford. There's then too much resource spent, I think, on going through some of those cases, and the allocation of those resources that they can ill afford because they would love to put them on something else. And they are actually very small. Their teams are very small, and they have a lot of responsibilities in the transfer pricing and sometimes also beyond. And you can also see this by some of the estimations that people have told us in their country what this can do. And some of them, and we said this before, it can take out, depending on the country, sometimes between 30 and 70% of your transfer pricing dispute pipeline. So it's quite significant.
Well, thanks a lot, Achim. I think like we are way over the hour. So thanks a lot, everyone, for the questions. As I said before, I will try to follow up separately with those that we haven't been able to address today. But again, thanks a lot, and we hope to see you soon in another OECD tax webinar. Thanks.
Bye-bye.